You might want diamonds, yachts, and designer gear. You might want a designer yacht made from diamonds. You might want to invest your inheritance safely, or pay off a mortgage, or give up the day job, or due to the current emergency, insert emergency here, you might not have a day job. You might have come here having seen the Tradespotting video on is trading cryptocurrency gambling? If not, you'll enjoy it all the more for having watched this one. Whatever the reason that brought you here to the Tradespotting channel, where goals and dreams meet ends and means, the point of this entirely free video is to give you a higher profit potential from trading. Just by watching, you'll make more money and take less risk. How is this possible, Jamie? Is this some of your Scottish magic that bounces round the mountains and held back the Romans? Can my eloquent prose alone affect your cognition? If you allow it, they can and they will. In today's video, I am going to use a simple metaphor to turn some maths into an interesting story that will demonstrate how managing your risk like a professional leads to higher returns than trading like a gambler. I want to make helpful and entertaining YouTube videos in return for genuine viewers who appreciate and like my content. So please click like so I can make better videos, and subscribe so that you'll be around to see them. And remember, none of this is financial advice. This is Tradespotting. How much can you afford to lose? Have you ever heard this phrase and wondered, what does it really mean? Maybe it means losing can be fun up to a point, or perhaps it's how much is the fun worth paying for? Neither of those sound very attractive to me. How about you? People come to trading for all sorts of different reasons. Some are seeking huge gains, others desperate gambles, and some are just here to have fun. 70% of them, whether they can afford it or not, end up trading to a loss. Those without professional experience tend to follow a similar pattern. They trade, win a little, lose a lot, get liquidated, start again, this time managing the risk on their liquidation point, win a little, lose a lot, get liquidated, start again, this time using technical analysis to justify making all the same mistakes, win a little, lose a lot, get liquidated. They don't understand the nature of the game, which is to set a maximum loss and then only trade when the odds are in your favor. Successful traders, on the other hand, all follow a strategy of limiting their risk and using probability to their advantage over time. This strategy of risk management isn't simply a way to ensure you never lose more than you can afford. It's also the way to make money over time. Let's demonstrate that with a quick game of chance at Jamie's coin flipping casino. You'll be trading the flip of a coin, so either heads or tails. There are only two possible outcomes, so your expectancy is 50%. And as it's a 50-50 chance, there is a 0.5 probability that it'll be either heads or tails. Jamie's coin flipping casino pays out 5 to 1, so if you bet $5, you'll get $30 back. That's $25 winnings and your $5 stake. That also means that you have a risk-reward ratio of 1 to 5. You have a budget of $10. So let's say you make your first trade. You risk $5 on heads. I flip the coin, it's tails, you lose, I keep your $5. You're now 50% down on your total account and really need a win. Of course, every flip of the coin is an independent event with an equal probability of being either heads or tails, but you correctly estimate that the chance of it being tails twice in a row is unlikely, i.e. the probability of 0.5 occurring twice in a row would be 0.5 times 2, which equals 0.25. So you're more likely to be right this time if you go with heads, right? So you risk your remaining $5 on heads. Tails. You lose. I keep your remaining $5 and I now have your entire account. So what went wrong for you here? Well, you lost more than you could afford. Your position size was too large. Perhaps you overestimated the short-term rewards and underestimated the long-term consequences of being wrong. Your first trade was so large that when it went wrong, you lost 50% of your account. And on your second trade, you assumed that because the probability of getting tails twice in a row was unlikely, that meant that you were more likely to win. This is simply not true. Every flip of the coin is an independent event with an equal probability of being heads or tails. To rely on probability theory means you need to give it time to work out, and you only gave it 2 opportunities, which meant that trading 50% of your account left you needing to be right 50% of the time, or you would have been liquidated. No worries though. Jamie's coin flipping casino, along with staggeringly good odds, also offers a no questions asked money back guarantee. So you can have all of your $10 back, and we'll try that again. On the first 4 flips of the coin, you could get it wrong. You'd then only have $6 left. On your 5th and 6th flips, you could get it right, and that would leave you in $6 in profit, or in other words, 60% up. You would have lost twice as often as you'd won, but you'd still be in profit. You'd be living a stress-free life, and you might even be enjoying yourself. So regardless of your risk-reward ratio, if you bet 50% of your account, then when your probabilities are only 0.5, you'll need to be right 50% of the time, or you'll be liquidated. Whereas if you only bet 10% of your account, you only need to be right 20% of the time. So this is what it means when someone asks you, how much can you afford to lose? Trading is very different from flipping coins. There are different parameters to consider in order to take a trade. But it is a handy metaphor for explaining how if you limit your maximum loss, then you need to be right less in order to make a profit. In trading, we limit the loss using a stop-loss order, and then we spot trades that work within our risk tolerance. For new traders, it's anything up to a couple of years, it's recommended to limit this to around 2% of your total account balance. We decide if we'll take trades based on their opportunity cost, and this gives us our risk-reward ratio. More on stop-loss orders, position size, and risk-reward ratios in the next episode of this series. So how much can you afford to lose? No more than will make you money over time. Ultimately, nobody can tell you what risk level will suit your personality or your bank balance, but I can help you articulate the benefits of prudence and patience. There is no help in rushing to be rich, and plenty of wealth in waiting to be right. If you want really good TA, search Rocky Outcrop on YouTube, and I'll see you back here in the next episode. Remember, none of this is financial advice. This is Tradespotting,